there's so much negative sentiment. I mean, as I look at the equity risk premium around the world, it's still fairly healthy. We're probably looking at a 3.5% spread for stocks over bonds. So you might say, well, I like that. But we're still fighting four headwinds: inflation, lower top line growth, declining margins, and of course, monetary tightening. And it's going to take some time to get through all four of these issues. So I think the sentiment is going to continue to be negative. It's going to take some time to work through these issues. For a while there, the equity risk premium gave us a little bit more protection. We had equity risk premium around the world around 4%. They've fallen probably to 3.5%. So we don't have as much protection on the downside as we did have.
Hal, it's an interesting question because obviously sitting out here in the center of things, if you will, when it comes to the energy narrative, we're also talking quite a bit about China and worries, frankly, about China growth. That obviously would impact energy prices potentially and outflows, but it would also be something that would be impacting the broader investor sentiment. How are you feeling about China today?
Well, China's very cheap, as we all know. You can buy China at 11 times earnings. So if you have a good long-term view of China, I suppose you like the idea of going in. You know, our view is a little bit different. I think China made some pretty big policy shifts a year ago that, quite frankly, aren't very favorable for long-term growth, particularly in the technology and internet and retail portions of the market. We're still in China, but we're overweighted SOEs, things that the government are backing. And you're right, the lockdowns really have been punitive on growth and had a pretty big impact on the global picture.
Another thing we've obviously been watching over the last several days is Trussonomics, what's happening with the BOE and with the United Kingdom, given that this is an administration or a government, if you will, who's just put forward a massive amount of tax cuts. So what do you think that means over the long term?
Well, it should be good for growth, right? It should spur growth. The market hasn't reacted very well, has it? I think the market would have liked to have seen the Bank of England be a little bit more aggressive. They're, of course, I think, playing catch up with the Fed, but they're starting to close in. And, you know, we'll see whether or not the fiscal stimulus is effective in spurring growth. The UK market was very interesting to us earlier in the year. It was cheap. Value stocks were favored over growth. And so the UK was a good place to be. But given the developments this summer, the last 2 months, it doesn't, paint a very good picture. And value stocks have become more vulnerable, in my opinion, than growth stocks today, given the broad economic slowdown.